Hi guys, Newborn Investor here and welcome back to another video. Today we're going to cover a topic that was requested a number of times by our viewers. I've heard you, and in this video we'll talk about my day trading strategy in detail. So if you appreciate my efforts, please do support by hitting the like and subscribe button. It takes a lot from me to record these videos, and your support keeps me motivated to put in the long hours for making these videos. Alright, there's a lot of learning to be done, so hold tight, relax, pause the video at times and take notes. Now, let's get right into it. First, what are the things I look for to actually get into a trade? I look at the pre-market conditions, identify support and resistance. Then I decide whether I should take a call position or a put position. Then I look for the option strike price that I need to trade. Based on the setups that I'm taking, I look at the level of retracements. Then I look for the actual setups or chart patterns. I basically trade 4 setups, the first 2 being either pullback or rebound setups, the third and fourth setup being breakout and breakdown setups. Then irrespective of the setups, how do I manage my stop loss? And then finally, before getting into the trade, I look for candlestick patterns and volume. So all these combined are the steps that I follow before getting into an actual trade. Now let's look at each of these steps individually. Firstly, the pre-market conditions. So what are the ideal pre-market conditions for my setups? To start with, I check for any events. Basically, I go to the CNBC websites and check the headlines. I look to see whether we have any major events coming out like the Fed minutes or inflation report. If there is one coming out, then I'll prepare myself for trading those news. Else, assuming it's going to be a normal day, I'll just continue with the next steps. The next step basically is to watch QQQ and SPY. SPY being the S&P 500 ETF and QQQ being the NASDAQ ETF. These two ETFs actually give me a broader perspective on how the tech sector and the S&P 500 is going to play out. Then I look at the trend. So what's the trend? Is it an uptrend or a downtrend? Ideal scenario would be where we have a clear uptrend or a clear downtrend. Now, if you don't have a clear trend, that's an important data point that tells me probably the markets are going to be choppy that day. So after my pre-market analysis, I form a bias. If it's a clear uptrend, then I'm bullish. If it's a clear downtrend, then I'm bearish. And if it's a mixed trend, I'll go into market open, assuming the markets are going to be choppy, and I'll wait for market open to see how both QQQ and SPY reacts, and then I define my trades based off the price action that I see. Once I'm done with the pre-market conditions at market open, I'll wait for a few minutes to decide whether I have to take calls or puts. Assuming you have a basic understanding how calls and put works, the next decision that I have to make is whether I should be trading calls or puts. Basically, I am a buyer of calls or puts. I don't sell calls or I don't sell puts, so I'm not going to cover that aspect of options in detail. So I buy calls when I'm bullish. I buy puts if I'm bearish. So how am I going to be profitable if I'm buying calls and buying puts? A call buyer profits when the underlying asset increases in price. If I'm assuming that a stock price is going to go higher, I buy calls at a cheaper price, and then when the stock moves, it takes the option premium also higher, and I could sell the same option that I bought for a lower price at a much higher price, and then I get to keep the difference. The same is the case with puts. Put buyer profits when the underlying asset decreases in price. So basically you buy a put option at a lower price, assuming that the stock price is going to go down. And when the stock price goes down, the put option premiums go higher, and then you sell at a higher price, thereby pocketing the difference. I hope this is clear. So at this point, from the pre-market trend and the first few minutes of market open, I would have a bias, and that bias would tell me whether I should be taking a call option or a put option trade. My next step would be to find support and resistance. So how do you find support and resistance? This is the question that I often get. Basically, support is a price level that prevents the stock price from falling further, and resistance is another price point that would prevent the stock price from rising higher. As a day trader, I rely on support and resistance heavily, and that is a very key ingredient for my trades. I don't use fancy indicators. I just look at the chart, find support and resistance. So the next question would be, what are the charting time frames that I use to find support and resistance? I basically use the daily and 5-minute chart. I don't go crazy. I don't use 1 minute or 3-minute charts. I use 5-minute and the daily chart to find support and resistance. We'll see actual examples in further slides. So how many support and resistance would I identify? Basically, I look at the 5-minute or daily chart and find 2 or 3 price points where the stock found support or resistance. Now, let me give you an example on how I look for support and resistance for SPY. So as you could see here, this is a daily chart of SPY. And you could clearly see the price points where it found resistance and it found support. So if I were to plot support levels on the daily chart, this is how I'm going to do it. This would be one level of support. A second level of support. As you could see here, I could trust this level more than the second support level because there are like multiple instances where SPY found support around 360. Now, I also do it on the 5-minute chart. So on the 5-minute chart, as you could see here, we do have support around this area and this area. One key thing that probably you need to check while marking support is like, how is the volume looking at that price area? If you have more volume, that confirms that a lot of buyers stepped in around that price level to actually support the stock and prevented it from falling further. Now, to find resistance, you have to do the same thing. Look at the daily chart and see at what levels SPY hesitated to move higher. So if I were to mark resistance, I would say like close to around 380 and 375. We have some huge resistance. Then 415, 430, 425 area. All these are resistance level. These are simple things. You just need to take a look at the chart and find different price points where the stock hesitated to move higher or lower. Now that out of the way, the next step in my trading process is to select the option strike price. So how do I pick my option contracts, or how do I select the strike prices of the option contracts that I trade? I trade near out of the money strike price. Now, what does that mean? So let's go back to Weibo and check what an out of the money strike price is. If you guys have been watching my live trades, I've been trading SPX for a while now. Earlier I used to trade Tesla, but lately I have moved completely to SPX. If you look at SPX chart, the current price of SPX, or the last closing price of SPX, is around $3,752. So if I go to the call option contracts, any option contract that has a strike price above the current price is in the money, and any option contract whose strike price is below the current price of SPX is out of the money. So here, the out of the money contracts would be starting with 3755, and all the contracts below are out of the money strike prices. If you go back to my slide, I trade near out of the money strike price. So why is it important? Reason number one, the option delta for near out of the money strike price is less. And what does option delta mean? For a change in dollar in the actual stock, what's going to be the change in the option premium? Let me explain. So let's go back to the trading screen again. The current price of SPX is around 3,752, and the strike price of this option is almost $3 away. So it has a very high probability of getting into the money. And if you look at the delta, it says 0.54, which is 54 cents. And what does this delta mean? For every $1 move in SPX, the option premium price moves by 54 cents. So I would trade an option strike price that has a fairly safe delta. So if I look at 3775, it's 41 cents. And if I go to 3800 strike price, it's only 25 cents. So if the trade goes against me, for every $1 SPX goes against me, I'm losing 25 cents on the option premium. So why do I care about delta so much? Let's get back to the slide. If the trade goes against you, the premium does not decay too much. By trading near out of the money strike price with fairly less delta, I'm able to manage my risk much better. My loss could be much less with a good stop loss. So if I trade a strike price with higher delta, the option premiums are going to go nuts, and I'll not be able to manage my loss properly. So that is why it is very important to trade a near out of the money strike price with a fairly okay delta. I hope this is clear, but if you have any questions on strike price selection and near out of the money strike price, reach out to me in the comment section below. I'll make sure to get back to you. Now we are almost done with all of my prerequisites for a trade. So let's get into the actual 4 setups that I trade. My first setup is Pullback Setup. This is my favorite setup and it works really well in a bull market. So what are the conditions that I watch for trading this setup? Since I'm always trading SPX, SPY matters a lot. So for me to play this setup, SPY should break the pre-market high and continue higher with volume. SPY should be green on the day and it should be the first or second pullback. Pullback should not retrace more than 50%. Stocks should not have any immediate resistance after breakout. And sometimes I make 1 or 2 ads within 50% retracement around support. Doesn't make any sense, right? So let's see this setup in play on a live trade. So this is a trade where I traded the pullback setup. As you could see, SPY is green on the day. It's breaking the pre-market high with volume. The first pullback, has not retraced more than 50%. I added. There is no immediate resistance. Selling. Locked in around $587 in profits. So as I said, these are the conditions. SPY is green on the day. It broke the pre-market high with volume. The first pullback, and pullback did not retrace more than 50%. So what do I mean by that? I got in this candle, and when it actually did a pullback, the pullback did not go more than 50% of this move. So it came right over here. That was a pullback. So it has not retraced more than 50%. I added. No immediate resistance. It had some room. So I let it run and then took profits on the way up. It's a perfect example of a pullback setup. Now, the rebound setup is exactly the opposite. In the first setup pullback, we were buying calls, but on the rebound setup, we will be buying puts. So what are the conditions for rebound setup? It should break the pre-market lows and continue lower with volume. SPY and QQQ should be red on the day, should be the first or second bounce. So instead of the first or second pullback, here we are looking at the first or second bounce, normally within the first 1 hour of market open. Rebound should not retrace more than 50%. Stock should not have immediate support after breakdown. And here also I'll be looking to add 2 times within the 50% retracement around resistance. So these are the conditions. Now let's get into a live example, which will obviously make things more clear. So as you could see here, a rebound setup is setting up. SPY is red on the day, so first condition is met. It's approaching the pre-market lows. Just broke the pre-market low with volume. The first rebound. I got in. The rebound or bounce did not retrace more than 50%. Now in this example, I think I got 2 ads. no immediate support. That's the next condition. I added twice, so this is the ideal setup. Sold and booked the profits of around $224. Now let's move on to the third setup, which is the breakout setup. Before we get into the details of the setup, I want to call out the fact that breakout setups are much riskier than pullback or rebound setups. So this is not my ideal setup. This is my backup setup. If we are in a choppy market, if I don't see anything moving, then I may look to trade these setups. So what are the conditions for these setups? SPY should be green on the day. Ideal scenario would be the retest of previous resistance. Retest would indicate that stock is strong. Probability of the setup increases as resistance is retested more. It is a breakout or bailout setup. What do I mean by that? If it doesn't break out, I just exit. Now let's see an actual example and then we'll come back to the slide. So here, SPY is actually near the pre-market high. First condition being SPY green on the day. Retesting previous high or resistance. The breakout happened. I got in. I got out. Now moving on to my fourth and final setup, which is exactly opposite to breakout setup. It's a breakdown setup. You anticipate a level to break down and then you buy puts. So what are the conditions for this setup? SPY should be red on the day. Ideal scenario would be retest of previous support. Retest would indicate that the stock is weak. Probability of breakdown increases as support is retested more. And then here too, it's breakdown or bailout. Let's see an actual example. In this example, I would like to show you how I traded Tesla breakdown using SPY. So SPY red on the day, SPY retested support. I was also watching Tesla on the side when this happened. For some reason, I did not trade SPX that day, but I was watching Tesla on my second screen. And when this level happened, like Tesla was also showing a similar pattern, retested the support level multiple times. And as it approached the breakdown point, I flipped to Tesla. And Tesla also had that support around 206. It broke down, retested a couple of times, it failed. I got in. I went in with 4 contracts since it was Tesla. And then I sold or scaled out, booking profits. Now let's get into the next slide where we talk about the most important lesson when it comes to day trading. Stop loss management. So how do I manage my stop loss? Firstly, going into the trade, I will always have an exit plan. We discussed all the 4 setups that I trade. Basically, I trade pullback or rebound setups and then breakout or breakdown setups. So for pullback or rebound setups, my stop would be near the 50% retracement. Now for the breakout or breakdown setup, the stop would be high or lows of the current candle. And sometimes if the breakout or breakdown candle is big, I'll have my stop near the 50% retracement level as well. So far it was lecture time, but I want to put whatever you have learned so far to test. So I want you to go back to my pullback, rebound, breakout, and breakdown setup example live trades. And I want you to comment on what would have been my stop loss for each of the setup. Pause the video now, go back to those live trades and comment the stop losses below. And now finally, the breakout or breakdown are work or kill setups. As I said, it's either it should break out or kill, breakdown or kill. So far, we have covered my setups and how I manage my stop loss. I want to talk about 2 other topics that should be read along with these setups. The first one is candlesticks and the candlesticks pattern. You have to read the setup along with candlestick pattern. Now, let me take this candlestick pattern along with the pullback setup. So on the pullback setup, as we discussed, the stock breaks the pre-market high, continues higher with volume, and then give you a pullback not more than 50%. And if I get this candle on that pullback, that is an extra confirmation that the stock is going to go higher. because this is a bullish candle and we call it as a bottoming tail. Sellers tried to move the stock price down and bulls came in and bought it up. And now on the rebound setup, if I take this candle, right? Stock broke the pre-market low, continued lower, and on the rebound, assume I got this candle. So what does that mean? The buyers tried to move the stock price up, sellers came in, dominated, taking the price down. Reading pattern along with the overall trend gives you extra confirmation on the setup. And now one more element apart from candlestick is the volume. If you have unusual volume, this gives extra confidence on the setup. So for example, if you're having a breakdown or a breakout, if the breakout and breakdown happens with unusual volume, that would mean that breakout or breakdown is more real and you can go in that setup with more confidence. So you have to read candlestick patterns along with volume to actually give you more confidence on the setups that we discussed. So that pretty much sums up my strategy in detail. This is exactly what I do every single day. I don't use indicators. I don't use scanners. I have no hidden strategy. This is exactly what I do every single day. Before we wrap up, I have 2 tips for you guys. Trend is your friend. Embrace it. If you see an uptrend, don't short it. If you see a downtrend, don't go long. And always, always, always stick to your stop loss, period. That's the golden rule you have to stick to, no matter what. So that would be it. I'll talk to you guys in my next video. Until then, stay safe and thanks for watching. Bye.